The deepest truth of financial history is that fate is rarely random. It is simply mathematics expressed through collective psychology. Every generation believes it's smarter than the last, and every generation proves itself wrong. In the Roaring '20s, cheap credit fueled a stock bubble that burst into the Great Depression. In the 2000s, cheap mortgages did the same, triggering the global financial crisis. Each time, experts swore it was different until it wasn't. The truth is, crashes are not rare accidents. They are inevitable mechanical events. They are the financial system's brutal business model. Easy money inflates assets, and ordinary people are left holding the bag. We stand at the precipice of a crisis anticipated for late 2026 or early 2027. This is not prophecy. This is pattern recognition. We are living through the exact identical structural setup that preceded the most devastating financial events in modern history. This documentary provides a deep forensic analysis of the coming collapse. We will show you exactly how crashes unfold, who loses everything, who profits enormously, and why the 2026-2027 crash could be worse than 1929 and 2008 combined. This time, the scale is larger, the leverage is higher, the interconnection is deeper, and most critically, the people in power have used all their ammunition fighting the last crisis, leaving nothing in reserve for the next one. Every crash begins with a bubble. And right now, in January 2025, we are not just in a bubble. We are in the largest everything bubble in human history. It's a systemic risk defined by the simultaneous inflation of three major asset classes. Stocks, real estate, and government bonds are all at historically dangerous levels. The most visible sign of delusion is the equity market. The stock market is operating at levels disconnected from any reasonable long-term fundamentals. Valuation extremes. As of January 2025, the S&P 500 stands at approximately 6,000. This peak is accompanied by a price-to-earnings, PE ratio, exceeding 28, a valuation level only higher in two previous periods, the peak of the 1929 mania and the 2000 dot-com bubble. The Buffett indicator. Warning. Warren Buffett's preferred valuation metric, market capitalization to gross domestic product, GDP, is flashing its loudest warning ever. Buffett himself stated that anything over 120% is dangerous. During the 2000 tech bubble peak, this indicator hit 145%. Before the 2007 financial crisis, it was 135%. Today, the Buffett indicator stands at 185%. We are 54% above the historically defined danger threshold. This is the most overvalued stock market in American history. Concentration risk, the Magnificent Seven. The stability of the S&P 500 is an illusion built on concentration risk. Only 7 massive tech stocks, the so-called Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla, represent 30% of the S&P 500's total market capitalization. Nvidia alone accounts for approximately 7% of the entire index, trading at a PE ratio above 65. If this AI hype fades, or if any of these few stocks miss earnings projections, the entire index could drop 50 to 70% swiftly. The 2008 crisis was localized largely to housing, but the current bubble is far more extreme. Worse than 2008. In 2008, housing was approximately 35% above the long-term trend line. Today, homes are 50% above trend, a valuation that is 43% worse than the peak of the 2008 mania. The median home price in major cities is at all-time highs, disconnected from the average income of citizens. The deepest structural flaw is the unprecedented global debt mountain. Unprecedented scale. The global economy is grappling with what many term the largest debt bubble in human history. By mid-2025, global debt had surged to a record-breaking $338 trillion, the U.S. fiscal crisis. The U.S. government is at the epicenter of this sovereign risk. America sits atop more than $36 trillion of debt. U.S. government debt to GDP ratio is now 125%. The consequence is devastating. Interest payments alone, $1.2 trillion annually, are now the largest single budget item. The warning from history, Rome and Mexico. This level of fiscal addiction mirrors the final terminal stages of previous empires. Rome went bankrupt financing wars and bloating spending, eventually collapsing under the weight of unpayable deficits. Mexico, AS 1982 default, when it shocked the world by saying, "We can't pay," is a reminder that debt makes a nation look rich until the bill comes due. America's debts are now bigger than Mexico's ever were. The 2026 setup is not merely similar to previous crashes. The underlying mechanics, leverage, belief, and the speed of collapse are identical. The Great Depression was triggered by the 1929 stock market crash, a crisis of excessive leverage. In the Roaring '20s, stock prices soared 400% between 1924 and 1929. Ordinary Americans bought shares on margin, borrowing up to 90% of the cost, with only 10% down. Margin debt reached 10% of GDP. Delusion. The collective belief was that crashes were impossible, famously declared as a permanently high plateau. Outcome? When the trigger hit, Black Tuesday, October 29, 1929, panic, selling forced liquidations, wiping out billions and shattering trust. The market fell 89% over 3 years. The 2008 Great Recession repeated the 1929 playbook, substituting one asset class for another. Leverage, cheap mortgages, and subprime lending fueled a housing market that doubled between 2000 and 2006. Mortgage debt reached 100% of GDP. Everyone was leveraged with toxic securities. Delusion. The lie this time was that housing never falls nationally. Outcome. Subprime mortgages defaulted, the cascade began, and the S&P fell 57% in 6 months. Banks that caused the disaster were declared too big to fail and were rescued with massive taxpayer bailouts, while families lost their homes and savings. The 2026 setup involves the same structural components. Bubble. We have the everything bubble, stocks, bonds, real estate, at simultaneous record valuations. Leverage. Corporate debt, consumer debt, and government debt are all at record highs. Belief. The delusion is that the Fed won't let markets crash. This is the modern version of the permanently high plateau. The ultimate reason the coming crash will be worse is the policy exhaustion of the Federal Reserve and the sovereign state. The fixes used in 1929 and 2008 no longer work because the last crisis consumed all the available policy ammunition. In every previous crisis, the central bank had immense firepower left to stabilize markets. The 2008 fixes. In 2008, the Fed cut interest rates from 5.25% down to 0%. It also launched quantitative easing, QE, expanding its balance sheet from $800 billion to $4 trillion. The government could easily borrow for bailouts because debt was only 67% of GDP. The 2026 constraint. Today, the Fed is cornered between inflation and default. Rate cuts. The Fed cannot cut rates to zero because inflation remains elevated. They are trapped. Money printing. They cannot print unlimited money, QE, because they already did that between 2020 and 2022, injecting trillions and causing the worst inflation in 40 years. QE became the largest wealth transfer in history. Financial repression. Trap. The Fed is stuck in the financial repression trap, keeping interest rates pinned near zero, almost always below inflation, to silently erode the debt burden. This punishes savers and forces them to become forced speculators in risky assets, just to try to stay even. This strategy works as a silent tax to pay off government debt, but it guarantees that the public remains collateral for the system. In 2026, the government cannot borrow or raise taxes enough to handle another massive bailout. Debt limit. With $36 trillion in debt and a debt-to-GDP ratio of 125%, the U.S. government cannot borrow the trillions needed to bail out failing banks and corporations without risking a catastrophic spike in interest costs, or worse, a crisis of confidence in its own credit. The government trap. The crisis has migrated to the sovereign state itself. The government now faces a dilemma with no easy exit. Austerity, cutting spending, will cause a massive recession. Raising taxes will kill economic activity and prompt social unrest. Inflating away the debt, printing, will accelerate currency destruction. The IMF playbook. When nations cannot pay, they lose sovereignty to creditors. Mexico's 1982 default and Argentina's debt cycles demonstrate the brutal IMF playbook. Loans come with brutal conditions: cut public spending, freeze wages, and devalue currency. The rescue is rarely about the people, it is about protecting the creditors. When the U.S. government can no longer borrow, it faces the same inevitable loss of control. The underlying cause of the crash is always excessive valuation and leverage. The trigger is simply the pin pulled on the existing loaded financial dynamite. There are multiple candidates, but 3 scenarios stand out as the most likely triggers for the cascade. Trigger 1, commercial real estate, CRE, collapse. This is the most likely starting point. The CRE market faces a fundamental structural crisis, amplified by work-from-home trends and sharply rising interest rates. Over $2 trillion in CRE mortgages is maturing in 2025 and 2026, requiring refinancing at interest rates 3 times higher than their issuance rates. Major institutional players, including Brookfield and Blackstone, have already seen defaults begin. The loan maturities alone are projected to be around $957 billion in 2025. This wave of defaults will destroy regional banks that hold massive portfolios of these loans. Trigger 2, corporate debt crisis. The combination of high corporate debt, leveraged buyouts, cheap pandemic borrowing, and high interest rates creates a refinancing cliff. Corporations that borrowed at near zero rates now face refi rates of 7% or 8%. This will lead to a wave of major corporate bankruptcies and defaults, collapsing the high-yield bond market. Trigger 3. Geopolitical or black swan shock. The unexpected often triggers liquidation, as seen with the March 2020 pandemic. Any shock causing massive uncertainty, such as a war with China over Taiwan conflict in the Middle East, disrupting oil supplies, or a contested U.S. election with violence, could trigger a global flight to safety, cash, that forces massive asset liquidation across all markets. Once the trigger hits, the underlying cause takes over. The collapse follows a predictable, brutal 5-phase pattern based on the historical blueprints of 1929 and 2008. The timeline could compress or extend, but the sequence is locked. Phase 1. Initial shock, mid-2025 to early 2026. The trigger event happens: a major bank failure, a corporate default, or geopolitical shock. Markets fall 10 to 15% in days. Investors are surprised but not panicked. Regional bank stocks deteriorate and high-yield bond spreads widen. Phase 2. False recovery, spring 2026. The media and politicians declare the crisis contained. Markets stabilize or partially recover for 3 to 6 months. The Fed cuts rates modestly. Investors believe the crash is over and buy the dip. This false hope allows the disease, the widespread leverage and spreading defaults, to continue beneath the surface. Phase 3, the cascade, summer to fall 2026. This is the real crash, driven by forced liquidation and panic. Defaults accelerate across CRE and corporate debt. Credit freezes system-wide. The mechanism: leveraged investors receive margin calls. Those who borrowed to buy stocks are forced to sell, triggering more selling, known as cascading liquidation. The scale: the 2026 cascade could last 12 to 18 months, resulting in a 50 to 70% decline from peak to trough. Phase 4. Panic bottom, late 2026 to mid-2027. The market hits maximum fear. Unemployment could reach 10% or higher. Multiple bank failures occur. This is the moment when government intervention begins massively. The Fed cuts rates to zero, if possible, and Congress passes emergency stimulus. This is the time of maximum fear and maximum opportunity. Phase 5. Slow recovery, late 2027 to 2030 plus. Government intervention stabilizes markets. The economy recovers slowly. Unemployment falls. However, stocks might not reach 2025 peak levels again until 2032 or later. Recovery could take 5 to 10 years, potentially longer, because policy tools are exhausted. Every crash creates an enormous wealth transfer from those who don't see it coming to those who do. Crises don't destroy wealth. They transfer it. The middle class and small investors are always destroyed first. Exposure. Unlike 1929, when only about 10% of households owned stocks directly, today, over 58% of households are exposed via 401k retirement accounts. When markets fall, everyone is hit directly. The fiat trap. The middle class is destroyed by the illusion of stability. They save money based on government promises, only to see their assets inflated away by QE and their savings eroded by financial repression. They are fully invested and fully leveraged, making them vulnerable to margin calls and sudden losses. The silent tax. Inflation itself acts as a silent tax, transferring wealth from savers and wage earners to the government. Every crash makes someone very rich. The same playbook used in the past will create the next generation of billionaires in 2026. The 1929 playbook. Joseph Kennedy shorted stocks and emerged $50 million richer. Bernard Baruch held cash and gold, bought assets at depression prices, and grew wealthier. The 2008 playbook. John Paulson made $20 billion betting against subprime mortgages. Warren Buffett made billions buying Goldman Sachs and Bank of America at crisis prices. The 2026 playbook. The rich who survive and thrive are those who sold before, shorted during, and bought at the bottom. They have cash, gold, and access to capital and information. It is not theft, but understanding the cycle. Assets do not vanish in a crisis. They change hands, usually moving upward to those with liquidity. This is not financial advice, but pattern recognition suggests specific survival strategies based on what worked in 1929 and 2008. Reduce stock exposure. Investors currently 100% invested should reduce their exposure to 50% or 60%. The remainder should be held in cash reserves or short-duration treasury bills. Cash provides the optionality, dry powder, to take advantage of low asset prices post-crash. Hold hard assets. Hold 5% to 10% of the portfolio in physical gold or gold ETFs. When the crash comes and the Fed is forced to print money again, gold, the ultimate inflation and geopolitical hedge, will surge. Identify quality. Create a list of quality companies, Apple, Microsoft, Visa, Johnson & Johnson, with strong balance sheets and low debt. And when the crash happens and these stocks fall 50% or more, be prepared to buy them. Protect income. Reduce personal debt and build an ample emergency fund. Making yourself valuable at your job mitigates the risk of layoffs. Debt is the system. Reducing debt is self-defense. Psychological readiness. The hardest part is not the strategy. It's having the courage to buy when fear is maximum. In March 2009, buying stocks felt insane, but that is when fortunes were made. Prepare mentally now so you can act when panic peaks. The Stoic principle applies here. Financial freedom is not about having more, but about needing less and staying in control of one's mind and expectations. Watch the indicators. The warning signs are not just theoretical. They are visible now. Monitor commercial real estate default rates, regional bank stocks, and high-yield bond spreads. The uninversion of the yield curve in September 2024 historically precedes a recession by 3 to 12 months. When these indicators rapidly deteriorate, it is time to get defensive. The crash is coming because the iron law of finance dictates that the system cannot sustain infinite debt and delusion. The blueprint. The pattern is repeating, the bubble is inflated, the leverage is extreme, the belief in permanence is universal. We are waiting for the trigger. And when it comes, the 5-phase pattern, initial shock, false recovery, cascade, panic bottom, slow recovery, will play out. The transfer. Wealth will transfer from the unprepared to those who are positioned correctly. Lives will be destroyed, but fortunes will be made. In 10 years, economists will write papers analyzing why no one saw it coming, even though the pattern was obvious. The Great Depression, the financial crisis, and coming soon, the 2026-2027 crash. 3 times. Same pattern, same sequence, same wealth transfer. The only question is whether you'll see it coming or learn the pattern the hard way. History is clear. Those who understand the pattern survive and profit. Those who ignore it lose everything. The setup is complete. The pattern is repeating. The crash is coming. What you do with this information will determine which side of the wealth transfer you're on.